You know, in the world of investing, some documents aren't just history, they're basically a masterclass. And today, we're going to dive into one of the all-time greats, Warren Buffett's 1982 letter to shareholders. Seriously, this thing is a goldmine of transparency, pure logic, and timeless lessons on how to allocate capital.
So, right out of the gate, Buffett does something pretty wild. He tells his own shareholders to be suspicious of him. I mean, who does that and why? Well, it's because he's about to throw out a key performance metric that he himself had championed for years. And get this, he's doing it right as that very metric is starting to look, well, not so good. It's just this incredible display of intellectual honesty, and it really sets the tone for the whole letter.
Okay, so this brings us right to the heart of the matter, what you could call a problem with yardsticks. And it's a real puzzle, right? Why on earth would one of the most successful investors on the planet come out and publicly say, "Hey everyone, that tool I've been using to measure my own performance, yeah, it's broken."
So for years, Buffett's go-to metric was return on equity, or ROE. He told shareholders this was the number to watch. But by 1982, that number was telling a pretty ugly story. You can see it here. Berkshire's ROE had just cratered. It went from a really strong 19.4% a few years before, all the way down to 9.8%. Suddenly, the yardstick that made him look like a genius was, well, it was becoming a real liability.
But here's the really crucial part. It wasn't just that the number was going down. The bigger issue was that the metric itself was becoming useless, obsolete. The old yardstick, operating earnings over equity, it just wasn't working anymore. Why? Because Berkshire's whole strategy was changing. They were buying more and more partial stakes in public companies, and because of standard accounting rules, the real earnings from these incredible businesses were basically invisible on the books.
Now, Buffett is no fool. He knows exactly how this looks. He uses this great metaphor, right? He says most managers, when they miss the target, they just walk up to the wall and draw a new bullseye right around their arrow. Classic trick. But Buffett's saying, look, that's not what I'm doing. He's not just moving the bullseye, he's telling you the whole target is flawed, and that leads him to a much more elegant solution.
So what do you do when your yardstick breaks? Well, this gets us to the absolute core of the letter, this clash between accounting reality and economic reality. And instead of just cooking up some new self-serving metric, Buffett introduces this powerful idea he calls look-through earnings. It's basically a way to see through the accounting rules to what's really happening in the business. So what are economic earnings anyway? It's a really simple but powerful idea. As an owner, you have a claim on all the profits, not just the dividends they pay you, but also the money they keep and reinvest in the business. And it doesn't matter if you own 1% or 100%. That's the economic reality of being an owner, even if the official accounting statements don't reflect it. And Buffett uses Geico as the perfect example to hammer this home. So in 1982, if you looked at Berkshire's books, you'd see they got $3.5 million from their Geico investment. That was the cash dividend, the official by-the-book number. But wait for it. The economic reality? It was a whole different story. Berkshire's share of the earnings that Geico didn't pay out, the money they kept to grow the business, was a whopping $23 million. I mean, look at that gap. That's the chasm between accounting and reality. And when you added it all up, over $40 million in real earnings from their big investments were completely invisible. And this leads to, honestly, one of the most important takeaways for any serious investor ever. Accounting numbers are the beginning of your work, not the end. Your real job is to get underneath the hood and figure out the true economic engine of the business, because a lot of the time it's actually hidden by the very rules that are supposed to make things clear. Okay, so understanding a company's real value isn't just some academic thing, right? It has a very practical purpose. It tells you exactly how to act as an investor. And this is the perfect bridge to what Buffett famously calls the manic depressive market. This is how he turns all that chaos on Wall Street into a massive opportunity. This is just one of Buffett's all-time greatest metaphors. He's saying the market isn't some smart, efficient machine that weighs all the facts. No way! It's more like an auction house full of manic, depressive lemmings, just driven by emotion, swinging from total euphoria one day to deep despair the next. And if you're a rational investor, this isn't something to be scared of. It is literally the greatest opportunity you will ever get. So, what's your job in a market like that? Simple. You use those crazy mood swings. You find great businesses, you do the work to figure out what they're actually worth, and then you wait. You just sit there and wait for Mr. Market in one of his depressive fits to offer you a piece of that great business for a ridiculous price.
And that's when you pounce. You buy on value, not on what everyone else is feeling.
But, and this is a huge but, Buffett throws in a major warning. This whole strategy only works if you get the price right. You can buy the best company on earth, but if you overpay, you're going to get killed. As he puts it, paying too much can wipe out 10 years of good things happening at the business. It's that classic line, price is what you pay, value is what you get. Never forget it.
All right, next up, Buffett shifts gears. He goes from this high-level investment philosophy to some really sharp, in-the-weeds business analysis. And he uses his own backyard, the insurance industry, as a case study. What he gives us here is basically a timeless guide for looking at any tough, commodity-type business.
He calls it the depressing equation of business, and it's brutally simple. You take two things. One, an industry that always has too much capacity, meaning too many companies fighting over the same pie. Two, a product that, to the customer, is pretty much the same no matter who they buy it from. You mix those together, and what do you get? Almost always terrible profits for everybody involved.
And his analogy for this is perfect. Some things are different. You know, people walk into a store and ask for C's Candies by name. That's a brand. But think about it. When was the last time you heard someone ask for a specific brand of sugar in their coffee? Never. Sugar is a commodity. And what he's saying is that insurance, for the most part, is a lot more like sugar than it is like candy.
So if you find yourself stuck in one of these tough commodity businesses, are you just doomed? Buffett says no, there is a way out. But there's really only one path to making great money consistently. You have to be the low-cost guy. A huge, and this is the key part, a sustainable cost advantage is the only moat that's going to protect you. And for him, the poster child for this was, you guessed it, Geico.
All right, this last section. This might be the most important lesson in the whole letter, especially if you're a CEO or you're trying to figure out which CEOs to trust. It's all about issuing stock, when to do it, and more importantly, when not to. For Buffett, this is the ultimate litmus test. It tells you everything you need to know about a manager's discipline and who they're really working for.
And Buffett's rule here is just beautifully simple. It's ironclad. You do not issue new shares, which is, remember, a piece of your business, unless what you're getting in return is worth at least as much as the piece you're giving away. I mean, it sounds like basic common sense, right? But he points out that this rule gets broken all the time, constantly.
So why? Why do so many managers break this simple rule? Well, they get caught up in what Buffett calls managerial adrenaline, and they come up with all these excuses. You hear things like, oh, the company we're buying will be worth way more down the road, or we just have to grow. But in Buffett's world, these aren't reasons, they're just rationalizations for destroying the value that belongs to the owners.
And you know who helps managers make these bad decisions? Their advisors. Buffett nails it with that old line, don't ask the barber whether you need a haircut. Of course the barber's going to say yes. Investment bankers get paid big fees when deals get done, so of course they're going to tell the CEO that issuing stock is a great idea. Their incentive is to get the deal done, not to protect you, the shareholder.
And this is the key insight. You have to totally reframe how you think about this. When a CEO uses their own undervalued stock to buy another company, they're not acquiring a new business. What they're actually doing is selling a piece of their own great business too cheaply. It's a fundamental and, frankly, a disastrous mistake in capital allocation.
Look, everything in this 1982 letter is just as sharp and relevant today as it was back then. So that leaves us with one final thought, a question for you to think about. When you look at all the big acquisitions and the stock-fueled growth stories in the market today, if you put them through this tough, owner-focused filter, how many of them would actually pass Buffett's test? That's a question I think every single serious investor needs to be asking themselves.